Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings monthly conference call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press *0. I would now like to turn the meeting over to Sarah Petoskey. Please go ahead, Ms. Petoskey.
Thank you, everyone, for dialing into the Barometer Readings monthly conference call. My name is Sarah Petoskey, Regional Vice President of Sales at Barometer, and I'd like to thank all of you for your continued support. Joining us on the call, as usual, is David Burrows, President and Chief Investment Strategist, along with Paul Campbell, Head of Research and Co-Manager of our Tactical Balance Pool and Fund. Dave will provide a macro overview and speak to key themes in the portfolios. Paul will speak to some key holdings in our balance mandate and highlight recent changes. With that, I'll pass it over to Dave.
Hey, folks, thanks for tuning in today. Probably a good time to have a call, given where we are in the earnings season. Over the last few weeks, one of the key buyers in the market, corporations, have been out of the market leading into earnings. Share buybacks have been on the sidelines. As we work our way through the earnings season, we start to see buybacks reemerge. I thought it might be a good time to talk about a few of the key indicators, given what's been going on with the dollar, what's been going on with the U.S. dollar, and what's been going on with interest rates. Certainly lots of moving parts. Over the last 14 months, we have seen a steadily improving U.S. dollar versus the basket of world currencies, and leading into the early part of this year, certainly that ramp took an added trajectory higher. It's interesting, over the last 3 months, on what some would say was a very sharp move higher in the dollar, there started to be some backlash against U.S. S&P-driven companies with significant offshore revenues and earnings, and concern as to how that might impact earnings. So let's just talk a little bit about some of these pieces. We'll take them apart. We start with equity breadth globally. Equity breadth globally has been improving since the early part of December, where 40% of stocks were in long-term positive price trends. As we speak today, 54% of stocks are in positive long-term price trends, very close to the high end of its range over the last 5 months. We're about 1.5% off the highs. If you take a look geographically in the U.S., breadth readings, most recent chart point was 62%. That was up from 36% in October of last year. So we've seen very steady improving breadth in the U.S. And in fact, the chart point today is 63.5%, just about to put another box in. So certainly some movement around at the sector level, but the overall breadth readings for the U.S. markets are hitting a new rally high. In the Canadian market, breadth has been slowly improving since December, where breadth readings were at 38%. Today, sitting at 53%, a new chart high. So breadth in North America does continue to be resilient and actually does continue to improve, even though at the index level, we certainly have seen the market take a breather over the last few weeks, but very close to highs. Of course, NASDAQ made a new high recently. S&P, still really within a whisper of its highs. And if we look at where the breadth leadership was globally in January, it was largely consumer-led developed economies. Today, that joined with countries such as Brazil, Singapore, Australia, Hong Kong, Malaysia. So we've seen breadth expand into developing markets, and certainly we've started to see some improvement in global PMIs, both in emerging markets and in European markets. So here we are in the end of April, beginning of May. Breadth readings are improving for equities. Let's take a look at some of the other asset classes. We'll look at the U.S. dollar. While it remains in a solid long-term uptrend, it is certainly taking a pause. Dollar index hit a high of 100 versus the basket of world currencies. We've backed off about 5%. Certainly not nothing goes straight higher, but we are seeing a little bit of correction in the U.S. dollar, and that's had implications for some of the sector leadership. When we look at fixed income, the 10-year bond hit a high in February and has backed off to a lower high and is working its way lower. So at this point, fixed income looks to be in correction mode, and long rates have been moving higher. So that has implications at the sector level. The first and probably most obvious place that benefits is the financials. As you know, we have a fairly significant weight in insurance, and while there has been some back off in some leadership groups, financials have been hanging in very well. The insurance companies, both P&C and life insurance companies in the U.S., have been stable over the last few weeks despite a little market volatility. Regional banks yesterday made a new high coming out of a 12-month sideways base, and so we're seeing improvement there. On the consumer side, consumer discretionary stocks have pulled back over the last couple of weeks, certainly not breaking trend, but have been consolidating really since the end of February, as have technology, save software when software is broken out to new highs. So no damage to these two themes, although certainly they have been taking a breather over the last few weeks as some of the oversold groups in the market have had some retracement rally. NASDAQ 100, as of 3 days ago, made a new high, and so the takeaway there is as the U.S. dollar is correcting within long-term uptrend, you have seen a reemergence of large cap names. So many of the large cap tech names have gained on a relative strength basis, and some of the very large multinational S&P companies have behaved a little better over the last few weeks. On the commodity front, certainly energy has had a bounce, crude coming from about $45 to $57, $58, and that again looks to be retracement in a long downtrend. We'll talk about that in a few minutes. Well, actually, why don't we talk about it now? So oil prices have been moving higher. If you look at the forward future strip, while the spot prices have rallied, the further out years are coming down in price. And many believe that has to do with the fact that some of the low-cost producers can hedge at these prices and be profitable. When we look at the producers, it's hard for us to get excited despite the fact that energy has bounced. If you look at E&P companies, they're currently trading at 3.5 standard deviations above their historical price to cash flow multiples. So if you go back to 1994, so 20 years, there has not been a time when E&P has been as expensive or even close as it is right now. Inventories continue to hit new highs as far as oil goes, and if you take a look at the list of uncompleted wells, in the Bakken there's over 600 wells that have been drilled but not completed. In the Eagle Ford there's 1,300 wells drilled and not completed, and in the Permian 1,500 wells drilled and not completed. It's our belief that with this type of move higher in oil, you'll have producers hedge and go on with production, so it's likely we'll see the rig count start to rise again. When we look at seasonality for oil, if you take the last 5 years, the worst month of the year is May, which is in front of us. When you look at producers, the worst month of the year, for the last 5 years being solidly negative, is the month of May. So this has been a bounce that we have chosen not to step on top of. We look for prices that are working their way higher and fundamental characteristics that support something changing for the better. At this point, we don't see fundamental characteristics changing for the better, and certainly some very sold-out names have had a bounce, but as far as we can tell, it looks as though the average E&P company is trading at about $95 oil. So there's not much upside there. If we look at this, if you look at the portfolios, the income portfolio today is sitting about 60% in the U.S., about 35% in Canada. On the Canadian dollar, Canadian dollar short-term reversal caused us to hedge Canadian dollars versus U.S. dollars. So we are hedged back to Canadian dollars. We don't have currency risk on this little pullback in the U.S. dollar. Financials continue to be our biggest weight. The portfolio is structured for lower bond prices, higher yields. So roughly 30% of the portfolio is there in financials, and that's made up of life insurance companies, regional banks, and capital markets. We see good, strong dividend growth from these two sectors. Consumer discretionary is 18% of the portfolio, healthcare 10.8%. So just to go through a few of the names, on the financials, Great-West Life, Manulife stand out in the insurance companies. In capital markets, Goldman Sachs and JP Morgan. And when we get down to consumer discretionary, Home Depot, Lowe's, Starbucks, Target, and Disney. So the key themes that we're focused on, we believe are intact. We do recognize that there's been some shifts in the currency on a short-term basis, and we've hedged back to Canadian dollars. We do have some European exposure, but our concern has been in a back off in the euro, a strengthening in the euro. It would be tough for European markets. We saw some difficult reaction there today, but we are long Siemens and Capgemini in technology. As far as dividend growth goes, we expect it to continue. Payouts continue to be low, and cash balances continue to be high. So in the short run, Canadian dollar probably could run to 84, 85 cents. We think that is just simply retracement within long-term downtrend. U.S. dollar could pull back to 92, 93, maybe lower, but that's again short-term retracement. The key themes, both for equities and for the sectors that we're focused on, appear to be intact. So what I want to do, I want to pass over to Paul and get him to talk a little bit about the balanced pool, balanced fund, and give you some color on what's been going on there.
Okay, thanks, Dave. Key themes of the portfolio, very similar as Dave has outlined. We're still bullish on equities. The fixed income allocation in the balanced fund and pool is slightly above 26%. That's very close to the 25% minimum fixed income allocation, so again, in keeping with our bullish outlook. Largest sectoral weighting is financials. In Canada, we prefer insurance over the Canadian banks, and we also have some U.S. banks. Wells Fargo, we've recently added Citigroup to the bank weighting in the balanced fund. Information technology is also a significant weighting. We have Apple, and in fintech area, we have Fiserv, DH Corp, MarketAxess. Consumer discretionary is also still a substantial weighting, along with healthcare, where we have J&J among the diversified, and McKesson Corp, a large U.S. pharma distributor. A couple stocks to highlight. One would be DH Corp. This is a Canadian-based financial technology company. Historically, they've been dominant in the Canadian financial technology area, particularly check printing. They have over 90% share of that market, so it's a significant cash cow, but very limited opportunity to grow. As an outlet for growth, they've been pursuing acquisitions very successfully in the United States. Harland was acquired in 2013. They've done a good job of integrating that acquisition, and they are realizing the benefits of that. And they recently announced another large U.S. acquisition by the name of Fundtech. It's the leading U.S. provider of U.S. transaction technology and software to the largest banks in the U.S. and around the world. So that looks to have significant opportunities. Another key driver for the company is the increase in regulations that the banks are having to deal with. So as a consequence, they're outsourcing more and more of their operations. DH Corp is a significant beneficiary of this ongoing trend. And as well, there's new technologies that are emerging with cloud computing, big data, software as a service. The DH Corp is also able to integrate into into its current offering and expand its markets and opportunities. So continue to like DH Corp. Market Access, another stock that I mentioned in the technology financial area. It's an electronic bond trading platform for a variety of fixed income and derivative Eurobond emerging market products. Really, the fixed income area is well behind the equity trading area in terms of movement to electronic trading platforms. So Market Access is a significant beneficiary of this whole trend. They've built a platform that has significant scale. It's over 1,000 investors and broker-dealer firms that use it. There's a variety of value-added services that Market Access can provide around their bond trading platform, including market data and market analytics. As the regulatory burden on investment banks and bond dealers has increased and the capital requirements for trading have increased, that's caused a withdrawal of liquidity from the market. Again, Market Access has been a beneficiary of that trend. So we're looking for continued strong earnings growth, greater than 20% per year over the next 5 years. The business is really capital. Once they've built the bond trading platform, it's just a question of growing their share, increasing throughput, and they generate significant earnings leverage on the back of that. The company pays a modest dividend, which we expect to grow, and it's also buying back stock. So we also like Market Access. A recent addition to the portfolio is General Electric. A couple weeks ago, they announced their deal to sell their commercial real estate holdings for $26.5 billion, which is a sizable deal. But in addition to this, they're looking to shrink dramatically their GE Capital operations, which last year generated over 42% of the company's profits. They're looking to bring that down to 25% by 2016. That's going to free up a substantial amount of capital. The board of directors has also approved the buyback of $50 billion of stock over the next 2 years. That's over 20% of the company. So that's also substantial. The big benefit that's hard to quantify, but I do believe it is a substantial benefit, is that they're looking to lose their status as a bank and as a systemically important financial institution. That's increased their regulatory burden significantly since the financial crisis, and it's really impaired their ability to operate as a pure industrial company. So we see the company returning to their roots as an industrial, leading global industrial. People forget that they're leaders in jet engine technology, locomotive, healthcare, turbines, and they've also shifted their business significantly away from simply selling products to selling services and generating income from those services over time. So we see significant benefits emerging in terms of return on capital and just operating flexibility. And we've recently added General Electric to the portfolio. Also, as I mentioned, Citigroup we've added as they move through their restructuring, again releasing significant surplus capital, looking them to be buying back stock, increasing the dividend as they refocus. And another one we've added recently is Dream Global REIT. This is a European office REIT focused in Germany. It's listed in Canada. The German real estate market is looking quite attractive. Property yields north of 6%. German bond yields are negative at the short end of the curve and below 1%, well up the curve. So property prices in Germany look set to move higher. Significant institutional investors are looking for increased exposure in Germany. We see this as an opportunity to participate. And the current dividend yield around 7% and looks sustainable. So that is latest update.
Great. So just to kind of wrap up here, from a macro standpoint, indication continues to point to flows in equities. Certainly the market has been correcting. Market has moved sideways really over the last 3-4 months. We have seen correction in some of the key themes. Corrections come two ways. They come in price or they come in time. So after a good finish last year, we've seen some of the leading groups take a breather. There has not been breakdown from a price behavior. When we look at our bottom-up security selection, we are getting good dividend increases. And as we come through this earnings period, our companies have yet to disappoint. So we're seeing strong fundamentals in the individual securities. We are seeing continuation in the key themes. We are seeing some time correction take place, which is fine. But our expectation is, based on the breadth readings, that as we start to see global PMIs improve, and we're seeing it in Europe and we're seeing it in emerging markets, it should start to flow through the rest of the global economy. Certainly North America was impacted by weak economic data from weather early in the winter. Over the next couple of months, we should start to see that data improve. The Fed said as much today. Their view is that these are transitory issues, not something that's more substantial. For us, the proof is in the pudding in the way the market behaves, and the market is sucking up bad news pretty well. So we're happy with how things are going year to date in the bulk of our mandates. Our equity balanced and ETF long-short mandates are all up anywhere sort of from 4 to 7% on the year. We are somewhat frustrated with the income portfolio so far this year. We're comfortable with the positioning. We're comfortable with the themes. And we know with patience this is a strategy that works well. So we want to thank you for your patience. We want to thank you for being clients. And certainly we're happy to open it up for questions.